up ahead. Affirmative 612.
Time for another edition of the Wealthy Pilots Podcast with Scott Osborn and myself. And Scott, I thought we'd talk about, we're in September, and September and October kind of have this, historically bad, or at least the perception that they're bad for investing. So let's talk a little bit about, is that true? Why might that be? And, and as a planner, what do you think about this and how do you attack it?
Yeah, I mean, as you were talking, the Taylor Swift song "Bad Reputation" came to mind because it's always jamming in my house of girls. But yeah, and it's it's a little unwarranted. It's interesting. I think some of the talking heads of the internet world, which I guess I'm one of, but they love they love to incite fear via clickable headlines, whatever.
Sure.
Clickbait or whatever. So. I've seen them out there, right? I mean, and if you Googled it, you can see some bad ones around like, why is September a bad month to invest? And it's interesting because like I started pulling some data, right? Looking at the last 20 years.
Okay. All right.
If we looked at the last 20 years, this goes back to some of my training in statistics, right? So my favorite quote from a statistics standpoint, in God we trust, but all others must bring data. And that's probably what we should title this episode. In God we trust, but all others must bring data. And here's why.
I like that.
Yeah. And, because any good statistician will tell you 86% of statistics are made up on the spot, including that one I just gave you. So it's like, we know stats can be twisted and turned and used, manipulated to tell any sort of story you want. So if we kind of peel back the onion and what you might say is, hey, if I look back at the last 20 years, historically the September returns are actually slightly negative. But if I look at the average monthly return of the history of the stock market, monthly return is 0.89%. It makes sense. I mean, stock market's given us about 10% a year divided by 12 months. Yeah, 0.89%. September has averaged minus 0.435% that's like the average monthly return for the month of September last 20 years.
Okay.
And again, that's, compared to the average monthly of what we said, roughly 0.89, man, you're lagging significantly behind that. So somebody might say, hey, if maybe I'll just scale back my portfolio in September because I'll be able to perform better. Mm-hmm. But again, if you peel back the data, and dude, this is like fundamental statistics, right? If I peel back the data a little bit and I just look at the returns year over year over year, the last 20 years, I can see if I plotted them out on a bell curve, right? If you took even one statistics class, I got my histogram here, regular curve, and I look at a couple standard deviations out and I find my outliers. On the high side, I don't have any outliers. On the low side, I have an outlier from 2008 of a down 20% in the month of September. What was going on in 2008? Global financial crisis.
Exactly.
Okay? So if I pull that out, if I pull that one outlier out, I see that my average bumps up to 0.62%, slightly below the average monthly. And so now we can start to look at, okay, if I ignore the outlier, I still see that September is lagging a little bit. And is there some reasons for that? And actually there are. So like one common one is many mutual fund companies will do their rebalancing in September. So this helps them to realize gains so they can have time for tax planning or tax loss harvesting inside of the mutual fund in the fourth quarter. And so a lot of times that rebalancing will cause, a little bit flatter returns in the month of September. But again, it's the majority of the time, 95% of the time, it's averaging positive returns. And so
you got third quarter as well, right? Third quarter company closeouts, gearing up for fourth quarter. There's a lot of that. Anyway, sorry.
Yeah, there's a lot of like end of year stuff going on inside of companies. And like different companies at this point may have like finalized their earnings outlook for the fourth quarter, and it's not as good as they were hoping. And so again, there's so much data that feeds into this that I wanted to at least take a little bit of time to say you have to be careful with what you're clicking on and reading and, designing your portfolio for. Now, I'll tell you my experience. I haven't seen too many people that have at least come into my office who are like, hey, I look at historical returns by month, and then I go to cash and go to equity exposure based off of those returns.
Right. Right.
So I don't see many people like actually implementing that, but I do hear people say, well, I know September is not really a good month for the market sometimes. And to me, I think that speaks more so to what I really want to talk to today, which is around our bias based off of the information that we think we know. And, ultimately on the surface level, you're going to be able to read things or hear different talking heads or pundits talk about, well, hey, September is historically a bad month for the markets. It's not true. It's not true. We have one statistical outlier over the last 2 decades that does drive a negative return, but it is not a historically bad month for the market. And again, every year is a little bit different. October is somewhat similar too. October has had some really big months in it. It's actually, October's got more volatility than September. So you have more higher than average months, but then we also have a handful of like back to the Great Depression, another carryover from the global financial crisis. You had the Black Monday or Black Friday trading.
Yeah, Black Monday back in 87. Yep.
In the 80s. And so you had like 3 statistical outliers that just tank the lifetime average of the month of October. So, but again, you have to look at the data and use better data to get better assumptions and get better outcomes. And so, that is really a portion that I think you have to be careful that we don't let what we see online or what we see some person blabbing about on a TV show,
right.
Influence our ability to make good investment decisions.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Well, people ask, Scott, should we be concerned, right? And to your point, while it is a trend, it's not a guarantee. Historical data shows a pattern of that weakness, but it doesn't necessarily guarantee that each and every September or each and every October is going to be bad. And that's where I think long-term comes back into play. What's the long-term game plan here?
Yeah, I mean, and that's where, again, like when I'm looking at short-term and long-term, those are 2 very important things to bring into the fold with what we want to discuss here. And so, I actually just had some communication go out to my clients around, I do think this is a good time to maybe stockpile some cash. Not under your pillow, but like in your account. It's not a bad time to have a little bit of what we call dry powder. And that's not because it's September. It's because, the market right now is up about 12% for the year. It's coming off, even though we had a rough start to the year, it's coming off of 2 back-to-back good calendar year returns. And so again, we're still trending above average returns. And so as we continue to trend above average returns, the longer that trend goes on, the more likely we are to have some sort of correction. Yeah. Why do corrections happen? I don't really know, but they do. They're triggered by many different things.
About 1,000 things, yeah.
Yeah, I mean, markets respond to news, and news is unpredictable, therefore markets are unpredictable. And so, sometimes the market just corrects because it's overpriced and it needs to come back down. And when the street's looking at price to earnings ratio and those kind of things, I mean, they'll start to trim some of their profits, and that's going to drive the market down a little bit.
Exactly.
It happens.
It's funny. I've been seeing all these fast food places, right, do their throwback pricing to the 90s, and they'll play 90s music, or the 2000s. Taco Bell's doing it, McDonald's doing it, so on and so forth. And it's a way it's a way to kind of go, oh, look, we want to kind of bring this fun back, but it's also a way for them to bring their prices back down a little bit without just fully admitting that they're bringing their prices back down, because they know it's overpriced, right?
Oh, yeah.
Now, we'd love to see that come down faster, but I think we're we're seeing that kind of effect start to happen, and the market does the same thing.
Absolutely. And I think too, if we look like as we sit here in September 2025, there's a lot of good data out there. I mean, like, the job market looks strong. Unemployment,
even after the correction.
Exactly. Unemployment has been a little bit more shaky, but it still is holding strong. Inflation numbers have come down. Now that there's still some rising price data out there,
sure,
which, technically is inflation, but there's a certain percentage that they're attributing to tariffs. And so the Fed still views that as a good thing in terms of validating that it's probably okay to cut rates, because
that's a whole argument and conversation right there. As a matter of fact, at the time we're taping this, they may make that announcement today or tomorrow. So whether or not they're going to do that. Yeah.
And so, I mean, to me, it's a little bit of back to that short-term, long-term thing. This is a really good time. If you're a near retiree and you're maybe very aggressive in your 401k, this is a good time to take a look back and say, hey, we're positive this year. We're really positive the last 2 years. We might be heading for some sort of correction here. And so it might be a good time to, scrape off some of those profits and make sure that I got my cash reserves built up for early retirement, or if you're a younger person, for college savings, home remodeling, whatever. Not that that's going to come out of the 401k, but for your other non-retirement investments, this can be a good time to look and make sure that you got the right amount of cash laid out there for yourself. I mean, and the other part that I'd like, probably really close with here on this one, Mark, is talking about, at the end of the day, if we're looking at any of this information from monthly returns or hearing different data and saying, oh, I need to get out of the market because of XYZ. That is a version of market timing. And I absolutely believe timing the market is a myth. And so on top of my beliefs, in God we trust, so don't trust me, but trust the data. What does the data say? Okay. From January 2003 to December 2022, I'm just going to hit a couple data points here. All right. So if I put 10 grand in the S&P 500 index in January of 03, and I just let it ride over that 20-year period to December 22, it'd be worth roughly $65,000, $64,844 technically. If I missed the 10 best days over 20 years, if I missed the 10 best days over 20 years, I'm down to 29,708. My returns are cut by more than half.
Wow.
By missing 10 days. If I missed the 60 best days of the market in a 20-year period, just 60 days, my returns are negative. I'm at $4,205. And so,
which is why Buffett says time in the market, not timing the market.
Time in the market is the most important thing. And so, to me, that's where it's important to look back at the data and say, man, if I'm going to get engaged in trying to time the market, then I got to be very confident that my technique, whatever it is really, really good. Because if not, you're running a significant risk of missing the market. And dude, I'm telling you, we saw it happen earlier this year. Tons of people panic selling during the
initial tariff, yeah. Mm-hmm.
And then we saw the market bounce back, almost 15% in 2 days.
All new highs. Yeah, exactly. Yep. All new highs, to your point, we're almost 13% up for year to date, and it's September. So yeah.
And dude, if you made some bad decisions on a Friday and then you were busy flying or working all week, dude, you missed out on that. You didn't have an opportunity to get back in. And so, and those people will never catch up. If you've missed a 15% bump in 2 days, you'll never catch up. And so that's where, again, the data does not support market timing. Again, is there times to apply some common sense or some, mathematical application to, building up some dry powder and that kind of thing? Absolutely. Buying different asset classes, rebalancing. Yes, there's a lot that goes into that. But when it comes to just trying to get in and out, it can be a fool's errand for sure. So.
Yeah, I mean, so is September and October typically, tougher months? Sure, the data shows that. But at the end of the day, a complete, well-rounded strategy, especially throughout the year, right? And a long-term strategy is really what you need to be after. So if you need some help with that, sit down with Scott, get onto his calendar, go to retireairlines.com. That's retireairlines.com. You can just click on the description in the show notes to get some time onto his calendar that way. Give him a call, whatever you need to do, but take some action for yourself so that you're not, kind of panic reacting to various different headlines and things of that nature, because that's certainly our world now. So thanks for hanging out with us as always. Subscribe on Apple, Spotify, YouTube. Hit the thumbs up, notification bell, and all that good stuff so you catch new episodes when they come out. Scott, my friend, keep flying. Appreciate you, brother.
See you soon.
We'll see you next time here on the Wealthy Pilots Podcast with Scott Osborn.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.